All right, good evening. It is January 29th, Tuesday, and I'm Susie Sutton, the instructor for Managerial Accounting. Tonight, we're going to discuss budgeting, which is part of Unit 4. And it doesn't look like anybody is going to join us today, so I'll just go along, and if you're reviewing this recording and you have questions, just please email or give me a call. With budgeting, I believe the material said there are 4 key aspects, which are planning, control, goals or benchmarks, and measuring progress. I've seen this referred to otherwise as the budgeting cycle, and this might be easier to understand. And there are called prepare, approval, execute or implement, and then review. So planning would be preparing, control or approval, which means the budget is created and then someone has approved it. Someone other than the person or people who have prepared it, created it, has given a second set of eyes on it and either is controlling it, has approved it, whatever level of review of the creation of the budget there is in that involvement, that step, whether they have the final stamp saying yes or no, or they just give advice, they say what has to be changed, or just give guidance. So whether, control, approval, whatever that term is going to be for that organization. Then the next step would be execute or implement. Could also, look at it from goals and benchmarks, which, okay, when you start using the budget, then is it a monthly, annual? What are those goals and benchmarks that are set? And then review, measuring the progress. Okay, if it's a monthly budget, which typically, you may have an annual budget and it's broke up in months. You review it each month. How well did you meet each category? You have perhaps a budget for what your sales or revenue was, and then budget for your expenses. Pardon me. And one step a lot of companies have, they may have an acceptable variance allowance, and then anything outside those variances has to be reviewed more intensely. So if expenses are outside, let's say a 5% variance, then those accounts are, quote, pulled, and then all of the detail of those accounts are reviewed to find out why there wasn't variance that exceeded 5%. Was it something that was coded incorrectly, or was there a reason that the expenses were higher, and then are there adjustments that needed to be made? Was it just something that couldn't be changed? Just have to be able to account for that variance. And this is also true for when the variance, even in expenses, when the variance is lower, because if you budget for your expenses, and especially applies to those expenses related to production, if you expected that you're going to have a 7% material cost and you only had 2%, why didn't you use the materials that you expected to use, even though your production was right on target? So you have to dive into and look at that. Were things not coded properly, and so that material is going somewhere else? Are they not using the material they're supposed to in making that product? So are your widgets only getting 2 screws instead of 4? So even though something has less expenses than it's supposed to, it still needs reviewed. And also so that maybe 2 months down the line, you're not going to end up with a huge over percentage in variance. So that's another reason to look at it, because, okay, those bills didn't get in, so they didn't post those in, they didn't have invoices to post. So then that's when the accrual accounting comes into effect. You've heard cash accounting and accrual accounting. If you didn't get an invoice for materials that you received, you don't wait necessarily for that invoice to come in. That's when you accrue it. You make a journal entry saying, I should have this expense in this account. And then, so you would post it, and then you reverse that entry. When the invoice comes in, you reverse it, and then you post the invoice correctly. So that way, so you do look at your budget, and that's the review process, is looking at your variances for your actual numbers compared to what was budgeted. Now, important things to know about your budgets, and I'm sure this is very important with your home budget, and some of the, you might change some of the words, but it's important for your home budget, and very, very important for organizations and companies. The number one goal, it must be achievable. And that's true for your home budget too. We all want to say, well, we'd like to have $1 million in our savings account at the end of the year. That's not achievable. It's not realistic, at least for most of us. And even just saying, let's put $100,000 in the savings account by the end of the year. For a lot of us, that's not achievable. And it's just setting ourselves up for failure. So you have to have achievable budgets. And next, management must be supportive. They must be enthusiastic and committed to these budgets. They can't just set a budget and then expect everybody to adhere to it if they're not supportive of it and they're not committed to it. They can't say, oh, this is our budget. We have to cut expenses because times are lean, and expect everybody to adhere to it. Like, say, okay, I'm sorry, times are lean, so our employee funds are going to be cut a little bit this year. So instead of the annual employee picnic and a family Christmas party and an employee Thanksgiving party, the July 4th family picnic and the Memorial Day family picnic and Labor Day family picnic, we're only going to have one summer picnic for families and the Christmas party for families. That's all we can do this year. But then management, you see, going out every Friday night after work for meetings at the bars, or they go out for lunch meetings on company tab. Now, that's not being committed to those budget cuts. They could still be supportive of these other cuts, but if they're still not committed to the whole entire budget and expenses and cutting expenses, then they're not going to get complete support and enthusiasm from everybody if they're not on board as everyone else. The other thing is, you can't use a budget as a tool to pressure employees or to blame employees for a blame game. You still have a job to get done. Job has to be done right. Products have to be done, or products have to be built and built correctly. For the most part, companies are not going to design the budgets to create deficiencies with their products. I understand there are cases that might happen intentionally, and we're going to exclude those minorities, but for the most part, the budget cuts are going to come from other areas. And so you can't have employees say, oh, well, yeah, we were told to cut the budget, so I stopped using 4 screws and only am using 2 screws because first it's faster and second it's saving half the money. Well, no, because that's making a less quality part. And also, you cannot use the budget to pressure employees. You can't say, well, we have to save money, so I need you to get this done in half the time. When you know to do the job right, it takes 4 hours. You can't tell them they have to figure it out how to do it in 2. And using the budget as the reason and giving them the impression to do a substandard job and get it done in 2 hours because of the budget. Yes, there's ways that as managers and as employees that will work together to find more efficient ways to save money, save time, but you don't use the budget to blame and to pressure and say, well, you have to do it because of the budget. The budget says we have to cut expenses, and that's the reason. No, the budget isn't the reason. The budget isn't the tool. The budget isn't the blame. The budget's just a goal. We still have to do our jobs. We still have to do our jobs right. So we still, if it takes 4 screws and it takes 3 hours to get the job done, then you do the job right. And you work on reaching the goal. And you work with your manager, you work with your supervisor. How can we get the job done the best way possible? And can we do it to meet, and then in the end, meet the budget? If doing it this way, on this one part, we're not able to cut costs or cut expenses, is there another way we can? So you can't just, lean on the excuse of the budget and use that to blame. You have to still do the job right. Now, there's 2 different ways that budgets are created. There is what's called a self-imposed or a participative budget. That's where you have, I've said managers from all levels have input. Well, you have either SMEs, which are subject matter experts, or you have people from every business area, someone representing every business area that have knowledge and some control over costs and or the revenue from each area. They have input to the budget. They either meet with the accounting, or the accounting puts together a shell of a budget and then sends it to each one of these people in the department, whether it's the manager, the supervisor, perhaps the admin assistant, somebody in each department that has the financial knowledge of each process, and then they provide the information for their area. So then it's a team approach in building the budget. Now, you have to understand everyone must have similar goals, and that you all have to be on board that this year our goal is the company overall needs to increase revenue by 5%. and maintain expenses at the same expense level as last year. Or we have to cut expenses by 5% last year because revenue is going to stay the same. Everybody has to know what the same goals or have the same goals, because you can't have one area, you can't have sales over here saying, okay, we know what the market's like, so we aren't going to have any increase in sales this year because customer XYZ went out of business. Customer ABC, they are just maintaining. We have a little bit of increase from this customer and this customer. So we're not going to have any increase in revenue. And then you can't have your production department 2 thinking, okay, this is going to be a good year because they haven't heard from sales. This is going to be a good year, and just because they're hoping and they have positive attitude, saying, okay, this is going to be a good year. So they've created budgets thinking they're going to have 10% sales increase, and so they create a budget off of that. And then you have Danny Doubtful over here in the production area XYZ, that's always Danny Doubtful. So, okay, he's heard from sales that we lost 2 customers and that sales isn't looking real good. So he creates a budget thinking we're going to lose 15% of sales. And his budget's created off that. So you can't do that if you're going to have the participative budget where you have all your business areas put together their input. So first of all, you do have to have everybody's understanding this is what the goal is. But you do want their input because you as an accountant, while you understand the business, you may not understand every area's specific daily fight, daily struggle, and what their individual goals are for the year and what they hope to achieve. Perhaps Danny Doubtful actually has a new plan for the year. He's been thinking up something, and he thought of a new process that's going to increase productivity by 30%. So that will affect his budget. But if you don't know that, you wouldn't change the budget. So that's why you want to have the self-imposed or participative budget where people from each business area contribute and create the budget for their business area. You have sales, they add their budget based for what their sales goals, sales budget will be. Then the production adds what production budget would be based on those sales and what their plans will be for what they know is what's going to happen to productivity. If they know this production line is going to have to shut down for 5 months because they have to fix this unit or this big piece of machinery, then they have that information and can plan for it. Your inventory department, they should be very aware of changes in the industry of price fluctuations on steel prices with what pricing is happening with steel and the embargo rates and import and export rates and aluminum pricing and all that type of things. They should know what those pricing is going to happen. So they should be able to create a better budget off raw materials. So generally, everyone builds their budget together. So with that, everybody has their opinions are valued. You normally have much more achievable and accurate goals. So when you're doing your analysis each month, you will have fewer variance analysis or variances to look at. You're still going to have variances, but you won't have as many because when you built the budget, you had your experts building it together. And so you shouldn't have as many fluctuations because you were prepared. And then you usually have much more, much higher morale and motivation because you had those people involved in the daily business create the budget. So they take ownership. It's their budget, so they want to reach those goals. Most people take pride when they create something. They're more prideful, and it's their, it's kind of like it's their responsibility. They created it, so by gosh, they're going to do it. So you usually see a much higher morale and motivation when it's something that you have everybody from all the different business areas put together themselves. Then on the flip side, there is the mandated type budget, which management imposed budget. You often see this in large corporations, and this comes from the top down, like senior level management. And kind of opposite of what we were talking about, it deflates employee motivation. Top down says, okay, here's your budget. It tells sales, this is what your sales budget is. This is what your goals are. It tells inventory, this is what your inventory budget is. Yes, corporate level, they are going to know like embargo rates and sales, and a lot of times they're going to know raw material rates and those type pricing, but they may not know the nitty gritty and down to the detail of exactly what types of parts are needed and those type of fluctuations, or what kind of deals we can work with different suppliers. They're not going to know that this product line that we have a plan in action for reducing or increasing efficiency and reducing our time by 30%. They may not know that we have to shut this product line down for 5 months because we have to do maintenance on a piece of equipment. And we know when we shut it down, we're going to have to tear it down, get parts from overseas, and blah, blah, blah. So they have a mandated budget and don't have any idea of the intricacies and have input of the things that were going to happen down at the minute level that would impact the budget. So it often leads to unrealistic goals. They may not have known that we lost this customer. They didn't know that another big customer has lost customers. So while we're keeping our customer, that customer's sales levels are going to be flat. And we have a couple other customers that have already told us that their sales are going to go down. So they're giving us goals that we know we're not going to be reached, or we can't reach. And so then we'll have little motivation. We're already set up for failure. So you have no motivation to reach those goals because you can't. And then, all of this combined, employees get a sense of, a lack of respect because they feel like, okay, they don't value our opinions, they don't value our contributions, they don't think we know what we're doing. The impression they get are, corporate doesn't think we know what we're doing, corporate doesn't value, our opinions, doesn't value the information that we can provide. They're telling us what to do, and they don't know our business as well as we do, but yet they're trying to tell us how to do it. And so it just it usually creates a big cavern between then like senior management, corporate level management, or whoever it is that imposed this budget. And again, then you get this lack of motivation, you'll get some friction, you don't get buy-in on the budget, and you usually then have this budget that's here are these numbers, and it's not a goal, it's just this imposed budget that are just a set of numbers. You're going to have a lot of variances because nobody's using this budget as a goal. It's just a set of numbers. If you happen to hit those budget goals or budget numbers, then you were lucky, because you don't have anybody on the team working towards those because you have no buy-in. So whenever possible, this is not a good idea. It happens a lot, but just, I don't know why it continues to happen. It takes time, yes, to get contribution from your employees to create a budget, but it's not worth it to not take the time to do it. Even if it takes, a few hours a day for a week from your employees, it does a lot more damage to not get that buy-in from them. Can you imagine, like, okay, if you're married and your spouse is responsible for buying groceries, buying your children's supplies, taking care of your children's needs, but yet you create a budget and say, okay, this is how much you're going to spend on groceries for the year, and this is how much you're going to spend on your children on their after-school activities, on their sporting or extracurricular type activities, sports or music lessons, or play, participating in plays and drama type of groups, whatever they like to do. But you go to your spouse or partner and say, this is how much you have to spend, when that's what they've been doing for 2 or 3 years. I think you can all imagine what that is going to go over like. If you are still standing upright afterwards, it's not going to go over well. And fortunately, unfortunately, whatever, if management in the organization you're working in comes in and gives you that budget, you can't hit them upside the head with a brick like your spouse probably just did. But that is the same type of reaction that you probably will have when this happens. They have no idea what you're going through, but yet they just told you what you can spend or what you should spend and how you should spend it. And that just, I think I just pretty much summed it up, and it just doesn't work. So moving on, most organizations, they start with a master budget. And what I was just describing, both scenarios would be you have a master budget, then you have a sales budget, which is what your sales department would create. Then once you have a sales budget, then you have a production budget, inventory and materials budget, your labor or human resources budget. You have a I usually say sales, but selling, general and admin budget. And you have cash budget, which that's how you create like your cash flow. And then you have a budgeted income statement and budgeted balance sheet. So you put your budget together, and then the end result, you should be able to produce a projected income statement and balance sheet or budgeted financial statements saying, okay, next year, based on our budget, this is what our financials should look like. And, if you go through all this work and your financials look horrible, then you can back up and regroup. But that's the goal of everything, is to create this budget and then know where you should be at the end if you stay on budget. And the reason you create this sales budget first is you don't know what your production is going to be without your sales. Well, you shouldn't. I mean, why would you create 2,000 widgets if you're only going to sell 75? Or it doesn't do very good to budget to produce 50 widgets if you're planning on selling 75, unless you know you have a backlog. But, or a big, a bunch in, when I say backlog, you already have a lot in that you've produced sitting there waiting to be sold. But so you need to create your sales budget. So this is kind of order you would do it. So, and here is a kind of an image to kind of show you kind of your flow chart. So you create your sales budget, and then you create your production budget. Because once you know your sales, then you know how many you need to produce. Then when you have production budgets, that allows you to create your production or your inventory, your labor, and in this case, it says your manufacturing overhead budget. And the other slide, we called it, we just said inventory, labor, and selling, general, and administrative budget. It just depends on what level of detail you want to go into. So you have sales, then you know how many to produce, so you create your production budget. Then once you have a production budget, then you can budget how many headcount, how many people you need to budget for. Then you need to budget for your inventory. Then you'll need to budget your overhead expenses, your manufacturing overhead, and then your selling and admin, your expenses. And by doing this, then you have your budgeted income statement. This piece says is slightly different than what I said before. And then whether before your income statement or after your income statement, then you can do your cash budget. So you can kind of plan for your cash flow. So when you would plan your cash expenditures, when you're going to pay your bills, because you're going to have your payroll and then your inventory bills to pay for and your taxes and everything else. And so then you can do your budgeted balance sheet. This kind of shows the order that you would want to do your budgets, because you notice each one kind of builds on the other. It would be difficult to do your labor budget first before you did your sales budget, because you wouldn't know how many people to account for. Now, finally, I just wanted to cover, there can be different budgets. There can just be an overall budget. We're going to do a budget for Fred's airplanes. Or in this case, so Fred's airplanes, we're going to sell $7 million in Fred's airplanes, and this is it. Or you can also do budgets by area. In this case, this is from Toyota Motor Company, and it's segmented by areas. This is by geographical areas. So Toyota did budgets by North America, Asia, and Europe. So you could budget this is sales, but so you could do your budgets segments, by regions. If you sell by if you sell in different areas, you sell by state, by countries, by regions or zones of the United States, however your demographics are, you can set up your budget that way. And as you can see, they've set up their budgets by area in these different regions. And then another area, or another way you do your budgets, are by product lines. And this company sells educational products, and they set it up by 3 different product lines. They have CDs, DVDs, and e-learning or online learning. And so they have set it up so that they are doing their budgeted income statement, that they've budgeted overall about $8.5 million, but just over a third of the budget is going to come from CDs. Over a third of the budget is going to come from e-learning, and then less than a quarter of the budget is going to come from DVDs. So I guess it's just over a third of the budget's coming from CDs, just under half the budget, however you want. I'm sorry. It's hard to do these fractions, guessing at the fractions. So, you know, 3.6 million CDs and 3.8 million from online learning and 1.2 million from DVDs. So they've divided their budget from their product line segments. And this way they can say, okay, this is what they're estimating their CD line is. And as you can see, they are saying their CD line, their revenue is 3.6, then how they're breaking up, they're going to have their various expenses and what their bottom line would be for each product line. And then they do actually have, as you can see, they have some expenses that they can't trace to a specific division. So they come down and they have the individual income statement by product line, and then they have those comparable, then they take out these common fixed expenses and take it out of the bottom line for the total. Now you could do that, or some organizations may take this $10,000 and spread it between the product lines. They could either spread it evenly, or they could spread it out and distribute it by, let's say, if this 3.6 is 35% of the total, then they may take 35% of the 10,000 and attribute it to the CD line. If 3.8 is 45% of the total, then they would give 45% of the 10,000 to e-learning. So you could do it either way if you wanted to have the exact total of everything by product line. So if you could not trace something to a specific division, but yet you wanted the total of all the divisions down to the product line, then that's one way you could do it. So I hope this was informative, that you learned something about budgets. It just seemed, like budgets can be, easy to understand, an easy topic to grasp, but there are a lot of nuances to it. There's a lot of ways you can do them. As I said, it's best to have input from all the departments, and it's up to the organization how detailed they want to go, and how much review they do on whether it's monthly, annual basis. So there are a lot of variables to budgets. So while the concept might be an easy concept, it's just how detailed and how much they want to delve into it. So I hope this was helpful, and I will talk to you all later.